as we continue with chapter 10, I want to jump back and pick up just a piece of chapter 6. And we skipped chapter 6 at the time, and I told you we're going to come back and pick this up later. So I want to pick up just a piece of it. So chapter 6 looks at this concept of variable costing. And variable costing is just looking at when we are making decisions. Oftentimes, we only want to consider the relevant costs because oftentimes those are the only costs that are relevant. And the fixed costs are not relevant because they're usually not changing under the alternatives. Not always, just most of the time. So we have this concept of variable costing where variable costing is only looking at your variable manufacturing cost. So the idea is, remember, our manufacturing costs are direct materials, direct labor, and manufacturing overhead. Typically, direct materials are usually all variable. The more units you produce, the more materials you use, those are variable cost. Direct labor is usually a variable cost. The more units we produce, the more labor it takes, those are variable. But what happens is these overhead costs are both fixed and variable. So we have a lot of variable cost and overhead, such as utilities and things like that. But then we have a lot of fixed costs like supervisor salary, depreciation on the equipment, property taxes on the factory, rent on the factory. Those are all fixed costs. So even if we're making a decision of, let's say, whether we should accept a special order. So we'll talk about this one in the next video, but a special order is we have a customer that comes to us and they say, hey, we want you to make some of your product just for us. So an example that we commonly use is, hey, we're a baseball card company. We're like Topps baseball card company. And Cooperstown, Baseball Hall of Fame in Cooperstown comes to us and says, we want you to make some special baseball cards just for our Hall of Fame induction. Okay. Like, these are not things that we're going to sell to the regular customers. We are just making these for Cooperstown. Okay. Now, here's the thing. They're not going to pay the off-the-shelf pricing, so to speak, right? They want us to cut them a deal. And so we're having to decide, do we want to accept their special price, or do we want to say, yeah, no, that's not good enough, right? So if we were to accept their special order, we would certainly incur more materials costs because we would have to make more baseball cards. We would incur more labor costs because we would have to make more baseball cards. We would incur some extra overhead. We would have more utility costs probably. We would have more indirect materials, maybe more indirect labor. We would have some more variable overhead, but we would not have any more fixed overhead. The depreciation is not going up. The supervisor's salary is not going up. The property taxes are not going up. The rent or the mortgage payment on the factory is not going up. So those fixed costs are irrelevant to our decision. So we don't need to include them. We only need to focus on the variable product cost. That's all variable costing is. It's just saying, just for the purpose of making this decision, not forever, just for the purpose of making this decision, we're going to ignore those fixed costs. Now, absorption costing is what we have always been doing. You just didn't know it was called absorption costing. So absorption costing is, again, the whole thing that we've always done where materials, labor, and all overhead is a product cost. Okay. And then variable costing is where we're just temporarily pretending that fixed overhead is not a product cost, just for the purposes of making this temporary decision. So again, under absorption costing, this is what we've always done. This is our normal costing. And you can see our income statement is our normal income statement where we have revenue minus cost of goods sold gives us gross profit, minus selling and administrative gives us operating income. Variable costing is just pretending for temporary decision making. So it's just, we're just looking at this internally only, Okay, it's never going to be seen by anybody outside. So internally, we may choose to rearrange our income statement to say revenue minus all variable costs. So remember, this cost of goods sold, some of these are fixed and some of these are variable. And then we have our selling and administrative, some of which of these are fixed and some of which of these are variable. So the contribution margin format income statement, which we've looked at in Chapter 5 already, lists all variable cost, both product and period. Remember, selling and administrative expenses are also called period. That gives me contribution margin minus fixed cost, which are some product and some period. So let's work through and just an example here. So we are making tablet computers. We're making 2,000 of them. We normally sell them for $500. The materials cost are $150. The labor $75 per unit. The variable overhead is $20 per unit, and the fixed overhead is $111,000 per year. Right? So if we say $111,000 per year and we make 2,000 a year, then that means each fixed overhead is $55.50 per unit. So if I was going to calculate the absorption cost of one tablet, it would be the 150 of materials, the 75 of labor, the 20 of variable overhead, and the 55.50 of absorption costing. So this is what it really costs me to make one tablet computer. But let's say, pretend that we had a customer come to us and they were like, hey, we want you to make us 50 tablets just for our company, and we're maybe going to put our own logo on them or something. It's a special deal. We'll talk about that scenario more in the next video. When we're trying to decide, we don't need to include that $55 of fixed overhead because that's not relevant to the decision. That's not going to go up. So in that case, we would use the variable costing, which is just the materials, labor, and the variable overhead. So in that case, our cost that we're just considering for this one-time decision is the $245, not the $300.